Okay, I'm going to go ahead and call our meeting to order. We have an agenda before us. I'd be very happy to entertain a motion in a second to approve the agenda as presented. Do I have a motion? Motion, do I have a second?
Second.
All in favor, please say aye.
Aye.
All right, very good. We're going to start with the, what's it called? Thank you, the roll call. Thank you very much. All right, I haven't had enough coffee this morning. All right, I'll start. So John Bisher, member.
Gregory Williams, staff.
William Johnston, staff.
Brendan Vavrika, Anco Consulting.
Fred Martin, Discipline Growth Investors.
Nick Hansen, Discipline Growth Investors.
Dave Rader, member.
Patrick Keel, member. Bobby West, member.
And I believe we have someone from the city auditor's office on Zoom connection. If you could state your name.
Yeah, my name is Peter Damaris.
Thank you.
All right, thank you very much. All right, we have the minutes from our last meeting before you. I've reviewed them. I don't have any changes. Anyone else have any amendments to the minutes as presented? Motion to approve. Do I have a second?
Second.
All right, we have 2 seconds. All in favor, please say aye. Aye. Minutes are approved. All right, we have Nick and Fred from Discipline Growth Investors. Very, very long time portfolio managers, probably the longest serving manager here at the city for most of 40 years, I think. 42 years. Okay. Well, look, gentlemen, the floor is yours. I know you've been working on some transitions with the firm and keeping your kind of culture together. So I'd love to hear a little bit of update on that. And then if you could give us an update on the portfolio, that'd be fantastic. So.
Okay. So I'll kick it off, and Nick will do all the heavy lifting. I wanted to talk a little bit about, particularly, I know there's a couple new trustees talk about our DNA a little bit. That's how a firm operates, and then I'll update you on some of the changes. Nothing major. We're in the strongest shape that I can remember. Kind of interesting. And then I'll review performance, and Nick will talk about the investments. So we'll go from there. I have some written comments here because John said be brief. So I have an 11-minute talk, and I'm going to use this, and it helps me articulate better. So first of all, let me begin. 42 years ago, is in 1981, it's March of 1981, the city of Gainesville hired me to manage a portion of the city's pension fund. At the time, I was working for a New York-based investment manager operating under a star system, and I was then 34 years old. In 1997, I decided to found an investment firm, Discipline Growth Investors, and based on our investment effectiveness, the trustees of the general fund and the police and fire transfer investment responsibility over to my new firm. Actually did not put out a bid, and I will be forever grateful for that trust in us, and I hope we validated that decision and will continue to validate it. It's my belief that every investment manager has a DNA. This DNA drives how the firm invests and how it manages its business. And I'd like to share with you our DNA, especially with the trustees. So in 97, I was an experienced investor, but I had really no experience in developing or managing an investment firm. And I think back to that, I realized that the very important group of building blocks was incubated 50 years ago, 25 years before we founded DGI. So let me go into that a little bit. So I went to an expensive private college, and my dad convinced me or conned me into a Navy scholarship. So the price of the scholarship was that I had an obligation to serve 4 years of active duty. So in 1969, I made my request to the Navy. I wanted to be on a destroyer out of Pearl Harbor. I went so far as buying a topographical chart of the Hawaiian Islands and putting in my dorm room and circled Pearl Harbor in red magic marker. And I'd like to be able to tell you that my decision was so long ago that I cannot remember why I chose Pearl Harbor. But the fact is, to this day, I cannot tell you the basis for my decision. I grew up in a small town in Indiana and had never traveled outside the continental United States. But here's the key fact that I should have known had I been a good decision maker at that point. Pearl Harbor was the primary staging point for Navy ships going to Vietnam. So my reward for being assigned to a destroyer in Pearl Harbor is that I had 3 7-month deployments to the Vietnam War. So effectively, about half of my active duty was in high-intensity war conditions with extreme stress and uncertainty. So I began as a division officer, and I ran the radar room with 16 people reporting to me. 2.5 years in, the captain called me into a stateroom and asked if I wanted to replace my boss who was being transferred. This job was normally done by officers with 2 or 3 times my length of service and after a 6-month destroyer school in Newport, Rhode Island. Being a brash 24-year-old, of course I accepted on the spot. But instead of 1 division and 16 people, now I oversaw 4 divisions and 65 people. I advised the captain on all operations matters, and we were headed back to Vietnam shortly after my promotion. So it's safe to say my military service was intense and life-changing. I went in as a boy with undeveloped decision-making skills and came out as a man. I do not believe I have ever worked as long or as hard. There was a dormant silver lining to my service, because I learned 5 things that just laid there until it came time to establish DGI. So here's the 5. The Navy is a mission-based organization. DGI is a mission-based organization. We're not AUM or product-based. We're a mission-driven organization. The Navy was focused on education and training. DGI is focused on education and training, continuous, never stops. The Navy was disciplined about adhering to processes and procedures. DGI believes there are processes meant to be followed in the moment and thoughtfully improved. The Navy believed in clarity and responsibilities and decision rights, ditto for DGI. The Navy believed that officers should be far more than managers. In the war zone, I stood watch for 8 hours every day and managed my department in my spare time. At DGI, senior investment personnel are analysts as well as PMs with direct account responsibility. We might lose a little efficiency, but we believe our client contacts makes us better investors. We've always had a look through, and we report to you, but ultimately we serve the employees of the city of Gainesville. It's a look through. So DGI was established as a mission-driven organization. We would adhere to our process and push for continuous improvement, letting the results flow from our efforts. And these lessons remain a core part of DGI to this day. Now, the other part of our DNA is our attitude towards performance. How do we think about high performance? What about sustainability? So we think superior performance can be intentional. It is a byproduct of doing things right. So I'm going to look at performance from 3 different perspectives. And let's start with the creation of an investment process. Nick, you want to pass out those?
Oh, yeah,
Everybody's got it. So if you'll look at DGI DNA and go to page 1, it says the 3 truths, okay? So we believe that our investment process must be aligned with the fundamental truths of investing. And there are 3 of them. Number 1, price is what you pay, value is what you get. In the short run, the stock market is a voting machine. In the long run, it's a weighing machine. You hear words of Buffett and Graham in there, Ben Graham and Warren Buffett. And without an adequate margin of safety, investing is just simply speculative. So I'm going to unpack each of these, okay? So price is what you pay and value is what you get. This means that you have to have a sufficient knowledge of your portfolio of companies. It's crucial to have that kind of knowledge. But that's just the starting point. You have to be able to figure out what your investment is worth today and for growth companies at some point in the future. If you can't figure out what it's worth, you have no idea what to pay for it. Simple. Second, in the short run, the stock market is a weighing machine. In the long run, it's a voting machine.
No, the way around.
You flipped it.
You said it the other way around.
Well, let me correct myself. That's
an important point.
I take that as a compliment. You're listening carefully. In the short run, the
You got me
stock
so
market.
far, but
You know what? I wrote it wrong. How about that? That's really smart. Okay, I thought I'd be a little better the other way. Okay. In the short run, the stock market is a voting machine. In the long run, it's a weighing machine. How's that? Did I get that right? Okay, thank you. This truth contains at least 2 kernels of wisdom. First, while stock market volatility is not unimportant for client retention, we have never accepted as a measure of risk, ever. Never will. For it is intuitively obvious that short-term downward market price decline makes stocks cheaper, but contain no investable information about the long-term future value of the company. Second, the only way to earn sustainably high returns in stocks is through long holding periods, to let the market weigh in on the value of the company. I get in trouble by saying the only way to do that, but that's true. Look at all the big concentrations of wealth, long holding periods. 3, without an adequate margin of safety, investing is simply speculative. Now, the process of building a margin of safety, here's how I'd like to have you think about it. Building a margin of safety prevents adverse events from becoming catastrophic. We build in margin of safety at the individual stock level and portfolio level. And in 2011, McGraw-Hill published our investment book that we wrote, which details how we build a margin of safety for growth stocks. If anybody wants a copy, I'm happy to send you one. It's still selling on Amazon, by the way. Okay, the second broad look at our performance is how we organize the business side of DGI, okay? So let's go to the next page here. And there are three sort of elements of how we organized our business. Number one, our business plans must be integrated with, but subordinate to our fiduciary obligation to our clients. Two, we would identify and ruthlessly remove every business impediment to achieving superior investment results. It's a process of elimination. Three, we would remain a single process investment manager with only two efforts, small cap growth and mid cap growth. That's what we did when you hired us way back. That's what we did when we were founded. It's the same thing. I'd like to think we've gotten better at it. You'd think if you only have to do one thing, you would get better at it. But those are the three guiding principles on the business side. So again, let's unpack each of these. Our business plans must be integrated with, but subordinate to our fiduciary obligation to you, our clients. We would maintain extreme financial strength as a firm and individual shareholders so that we could put our clients first, especially during difficult market conditions. We would not acquire other investment managers or move away from our sole focus on small and mid-cap stocks. We've been careful to pursue clients who would be attracted to our way of investing. We've been extremely careful to avoid those distribution networks which can flood a firm with assets and pile on charges which would significantly decrease our value proposition. We would identify and ruthlessly remove every business impediment to achieving superior investment results. We believe there is an inverse causal factor between excess assets under management and performance. Inverse. So you get excess assets, it's going to hurt your numbers. You make more money as a manager, but you don't have the same product. From our inception, we have accepted there is a natural limit to how much money we can invest successfully given our market focus. In small caps, we closed small caps, which is still the police and fire, and you guys were small caps for a long time. We closed it 15 years ago to new accounts. That's discipline, because you can't run too much in small caps in the way we do it. We are comfortable with our decision. This decision, however, has probably cost us tens of billions of dollars in assets under management and lots of income. So there's a trade-off. We'll take it. We do not have a budget limit on employee training, education, and technology. Those can be impediments to performance. We fully understand that managing assets is a most difficult endeavor. It can be severely damaging or fatal to let your guard down, ever. We would remain a single process investment manager with only two efforts, small cap growth and mid cap growth. Now there's an obvious advantage to only focusing on two segments. That is, our investment resources are solely focused on this, not diverting into looking at other things. There's a disadvantage. Our business risk is higher. We understand that. But it's a known risk, and we've hedged it two ways. We at DGI live well below our means. Individually, I do, and Nick does, everybody does. Because we know we have higher business risk. Second, we have developed a world-class client servicing team to build a solid long-term relationships able to withstand the inevitable periods of negative, nominal, or relative performance. So let's talk about the last part, which is, okay, I'm getting older. How sustainable is this? And we take that very seriously. So there are three parts to the sustainability question, three elements to it, and that's page 3. And they are our hiring process, our culture, and our succession plan. Okay? Our hiring process. Our goal when hiring someone, this is our goal, is that DGI is the last place they will work, regardless of their age when hired. Last place they work. Our hiring process is exhaustive, requiring many interviews. I think Nick had 22 or something like that.
Right around there.
For how many months was it?
Well, do you count when I was just talking to Rob and I didn't know I was being interviewed?
No.
That's 9 months roughly.
9 months, 20-some interviews, okay? Often the interviews are by cross-department. Many employees will interview somebody, okay? We hire for character and potential, not credentials. We also have developed a reputation as a great place to work, particularly for those innately driven to master their craft. When we hired two analysts a few years ago, we had 65 qualified resumes for one spot. Okay? That's a good barometer of whether people like us or not. This combination of great place to work, people want to master their craft, we attract the type of raw talent that we desire to hire, and our employee turnover, as you might expect, is very low. Culture. About 20 years ago, we realized that all organizations have a culture. Every organization has a culture. The question is, for us, was whether our culture was a lift or a drag to our effectiveness. So here's a quick story. As part of our culture journey, we identified many years ago and chose an agreed upon set of values. But something was missing because we chose the values. And I kept getting hung up, like people say, we have a value of integrity. No, you don't. That's a principle. You have to either have integrity or not. You can't choose, I'll have integrity today and tomorrow it's negotiable. So we came across a book that opened it up for us that there were 4 principles if you want to be a great firm. Integrity, personal responsibility, compassion, and forgiveness, interestingly, and you have to honor them. You can't avoid, you either have to honor them or dishonor them. These 4 principles have been the cornerstone of our cultural success. To this day, we recognize that an effective culture must be nurtured and improved. Succession planning, we get a lot of questions about this. Our founding shareholder agreement in '97 was designed to perpetuate the enterprise, not to make the founder and succeeding owners rich. It was to perpetuate the enterprise. Every shareholder must be a full-time employee. Our model is a cash distribution model, not a stock appreciation model. 98% of our shares are voting, 2% non-voting. We do not issue phantom shares. 20 years ago, we began an extended succession process. My ownership has declined from 100% then to 22% today. We now have 3 generations of investors, including Nick and his peers. 2/3 of our employees are now shareholders. For the last 20 years, I've been mentoring employees in client servicing, business management, and investing. Today, Rob and Koski are heavily focused on mentoring our investment team. We think of ourselves as craftsmen. My goal is to pour my experience and knowledge into them at a rate they can absorb. When we think about success planning, you should know that DGI employees and principals have a large investment in DGI strategies. As the founder, you could reasonably expect, what do you think my percent of my liquid assets that's lined up with you guys, what do you think my percent is? Like 50? That's up pretty high, doesn't it?
100.
100. And here's why, okay? If we think we're really good at investing in the most difficult market space, why would we trust anybody else with our money? So that concludes my remarks, and thank you for listening. Now I'm going to turn now to the book, okay? And in the Q&A, I'm happy to answer any questions, but was I on pretty much on time? Yeah.
16 minutes.
Oh, I got carried
I have a partner who's...
I interrupted it.
That's probably the
A
extra.
partner who's retired Navy submariner, and I've heard the first part of that talk before.
Oh, you have?
From him.
Are you retired? Are you?
No, he is, my partner.
Oh,
Is,
he heard that?
Well, that's the kind of thing he constantly recites about the principles
Oh,
underlying
it just was
his
amazing.
Navy career.
It was just by luck.
Yeah.
Honestly, it was.
Yeah. I think it's branded into...
Well, it is. When you spend 4 years and you're in a war zone for 2 of them,
Yeah.
you either have to kind of figure this out, or maybe you ought to go do something else, because you can't really do anything else because you're stuck in there. Okay. So a lot of soul searching. I realized how much I had brought that into the developing DGI, which we still follow this day. Okay, I'm going to update you now. If you turn to page 3, I'm so happy to announce that Rob Nikoski is our CIO, replaced me, although we're not big on titles, so it's kind of like a 3-year slide over, But anyway, he's the CIO now. I think it is long overdue. He's been there 20 years. He's just an amazing person, high integrity, brilliant. I can point to specific things he did with us, and let me digress just for a second. But we're at heart a value manager. We buy growth companies, but we apply a strong valuation discipline. That's what we are. And a lot of value managers haven't done very well for the last 10 or 15 years. So how do we do it? Well, when you think about value, a lot of value managers say P ratios. But that's one measure, but it's not necessarily the only measure of the value of enterprise, okay, for what it's worth. So Rob was the pioneer of saying we need to be value oriented, but in the changing world, you got to think about value maybe a little more expansively, okay? Just as an example, okay? And he continues to lead by example, and the guy, he's just, so I couldn't be happier. We also, as you know, a couple years ago, we lost our effervescent spirit, Robert Buss, who was hit by a train and killed. And we replaced him after a long search, 8 months, with a young man who was very promising. Came out of Mercer. He was a really highly respected consultant, and we're out. We have some capacity, so we're out. We're going to add some institutional clients over the next couple of years. We had 2 events. We had a member of the investment team leave, and we settled. It was a lawsuit. We settled it, bought his stock back. We put it in Treasury, and then when Robert died, we bought his stock back. So what happened was my percentage when all that happened went down to 22%. It went up to 32%. It wasn't anything I did. It's just that we took the stock in. That's going the wrong way. So at the end of the year, this last year, I sold a block of stock to employees. We broadened the number, and I'm just super happy about it. So what I mentioned earlier about this idea that our shareholder agreement is really not to make people rich. And I can tell you that the stock sales I've made have probably been at 1/3 of what I could get if I sold it to some third party, but I'm getting something for it, which is the perpetuation of the enterprise. Okay? And keep in mind, when you sell stock to employees, you're selling stock to people that help you create this wonderful company. So that's kind of an interesting way to think about it. We had 3 or 4 new shareholders.
Yeah, Katie, Cassie, Beth, and Evan.
So 4 new ones. What's our breakdown now? We have, of the 14 or so shareholders, I think, are half women now? I think they're...
Yep, right around.
It's either 6 or 7 are women, but we're not pandering to them. They earned it. These are, and the response has been unbelievably positive. I didn't think it'd be that positive, but it's fantastic. I'll probably do one more sale in 2 years. I'm headed down to about 10%. We have another access point. That's how we think about it. It's called Outlier Fund. It's more concentrated. We're happy to talk to you about it. It's long holding periods, so it's a 3-year lockup. It has an incentive relationship with it. We're not looking for a lot of money. When we've done anything, what we've done is do something that makes us better investors. And so this, we think, will help us become better investors. I can go into detail on that if you have questions. But any questions on where the firm is at the moment? I have to tell you that, I found that I've been doing this a long time. The investment team is the best I've ever been associated with. From top to bottom, from an employee standpoint, it's the best set of employees we've ever had. It's been a difficult few years with COVID and then losing Robert and a bunch of other stuff. But boy, I sure like our chances. And Nick will talk about what we're seeing in our stock portfolio. But boy, it's an interesting time. So I think we're in incredibly good shape today. It's been a challenge the last 3 or 4 years. So, any questions? Okay. So let's just review performance. Last year was a very difficult year for anybody in the growth area. We went down about 20, which is below the Russell Mid-Cap Index. We know at 20.5, the Mid-Cap Index, Russell Mid-Cap Growth was 27. Even with the downer, we've compounded at for almost 42 years at 14% a year. Russell mid-cap growth's 11.7, the S&P's 11. Those are significantly superior numbers, and the longevity of it is, there's a whole lot of cycles in those numbers, as you can imagine. Questions on that? And then, year to date, the market's very volatile right now. We look smarter than we are on this one. This was as of 15th because we had to do it. That was the cutoff to get the booklets down here. So we're up 13.5%. The mid-cap growth is 13 a little bit, and the mid-cap's 10, so growth is favored. We have wonderful companies, and the SP is about 8. Okay. Questions on that? And here's a number I always like, which is dollar results. In total, your hires were 2.9 million in 331.81. Taking out 54 million net, we made you 118 million on that. So we now have 68 million. I just, I don't know, you probably don't remember this, but when we came down one time after we added the police and fire profits and the general fund profits, which were then 100 million, so I brought a cake down and said, we're a $100 million money manager. Not that we run 100 million, but we made the city 100 million. And I have to share a secret goal of mine is, and I think we're trying to be as just absolutely as competitive as possible and as fit and ready to go, and I think we are. But wouldn't it be cool if we can get to 50? It's just a nice round number. So that's the goal I have, and not to slop our way to 50, but earn our way to 50. And this is just a reflection, but I'm trying to think, how many public plants have a manager, the same manager, for 42 years? I can't imagine very many. Anyway, I don't know what you've seen.
This is a small number.
So, but it's been an interesting journey. And so, questions on performance? You guys see all that stuff. So, any general questions of me?
You covered things very well, Fred. I appreciate that.
Even though I transpose those in writing, I transpose those.
It was just your writing, not our writing.
No, it was
Ours
my
was
writing.
right.
Was that right?
He was correct in ours.
Okay, there we go.
That's why it's helpful to have Beth working on that stuff
Yeah,
too.
no kidding.
All right, well, I'll try and not go for too long just because I know you guys are on a schedule as well. What I want to try and do first here is I'm starting with 2020, as I can see everyone's flipped ahead already. I'm just going to touch on the last few years in sequence here, not because I feel like you guys have forgotten any of this, but because I want to establish kind of a few key points that really, and talk about where we are now and why we're seeing what we're seeing. So in 2020, via COVID, obviously, I just put a chart in here that shows just the S&P 500, the Russell Mid-Cap, and the Russell 2000, so large, mids, and smalls. And that's just the market total return performance for the year. The piece I want to draw out of this chart is, as you might recall, the decline was precipitous. It was very, very quick. I remember because I was actually coming back from a vacation with my family. We were sitting in a pizza joint outside of Phoenix, and I was watching the markets on the TV behind my wife and kids, and I just kept seeing them go down, and my phone's starting to buzz. It's Fred calling me. I'm like, we got to get home. This has just gotten real. What happened, though, was a significant distortion of a lot of markets. If you remember, there were lockdowns. There were a lot of things that happened out there in the real economy that really distorted what was, what we could expect from business models. So most of our focus was on the portfolio itself, and that's going to be our first priority. We worked through the portfolio. You might recall we owned Royal Caribbean, we owned JetBlue. When people had significant exposure and risk, restaurants is another example, from lockdowns. All of a sudden you just have their entire revenue stream evaporate for an indefinite forward period of time. So that's what we were doing in that period. Normally we'd say, wow, there's a market downturn, we can go out there and go shopping. In this case, we were really focused on making sure the portfolio integrity was intact. The market snapped back really quickly. The fact that it finished up almost 20%, the small cap index actually did, by year end there, means the window of opportunity was fairly short. You go back to 2008 and 2009, we had months and months to poke around at the bottom and say, well, we want to buy more of this name in the portfolio. We found this name we've been watching for a while. It became a deliberate process here. A lot of it was just trying to say, okay, is there anything on fire, what do we need to worry about in this situation? So you didn't see a lot of new purchases into the portfolio at that time. Then you roll forward into 2021 here. Sort of 21 and for certain parts of the index all the way till the beginning of 22, large caps in particular, was valuation. Some of that was a residual because when Fred talked about price to earnings ratios as a value measure. And so what we're modifying this chart right here, it's a price to sales ratio. We use that because many of these companies didn't even have earnings. Luckily they did have sales, so we could measure them on that basis. And so we went and looked at the Russell Mid-Cap Growth Index, which is our primary benchmark with most of our clients, said how many companies are trading above 10 times sales. So there's a dollar-weighted portion of that index. And if you look, historically, and we had run this back further, we didn't show the entirety of the data set, but generally mid-single digits, depending on where we are in the cycle, is about where you'd expect. And these companies tend to be extremely profitable, deep moats. You see things like 30% plus sustainable operating margins with great growth prospects, and you see a valuation above 10 times sales. So in some sense, there is a small portion of the market that deserves a multiple like that. When you start to see companies with negative 200% operating margins that just recently came public in a novel space, trading at 20, 30, or 40 times sales, and it's not a small sales number either. This is not a problem of a small denominator in the ratio. These were companies that were trading at, look at Zoom, look at some of these, that were trading at multi-billion-dollar valuations. I believe Zoom, briefly, I want to say past Exxon in market capitalization. It is unreal. And to have, at the peak, 40% of the index trading at these just unrealistic valuations. I mean, you expect a few companies to actually justify paying that much money, but you don't expect 40% of the index. And there's just no way they all work out. And so the conclusion at that point was, this is pretty severe overvaluation. And by and large, if you look to the next page, a lot of our portfolio didn't see that sort of rampant overvaluation. There were still inexpensive, call it, stocks that we were invested in, but there were quite a number of stocks where that valuation excess did creep into the portfolio. Some of them we sold outright. You see a few down there. One of my favorite examples, you see 4 sales in the lower left. Well, let me orient you first. You've got the expected return of our overall portfolio in a gray line. And that goes from left to right. It was at about 10%, and then by the time it concludes in end of 2022, you see it up at 20%. So that's that gray line. In black, you see purchases into the portfolio, and in orange, you see sales from the portfolio, and those are oriented up and down on the expected return of those particular investments. So the expected return is just what we expect the stock or the portfolio to do on a returns basis, compounded over the next 7 years. That's our modeling horizon. And so if you look at the chart, it's very busy. I don't expect you to pay attention to everything, but the key kind of visual takeaway here, and the reason we use such a busy chart, which I know drives Fred up a wall.
That's an extra bonus.
Yeah, I'm just winning all over the place right now. is the fact that all the orange is below the line. And what you can take away from that is the fact that a lot of those sales through 2021 during this valuation excess, they were driven by valuation. In a normal environment, you will see some stocks with a high expected return, but we're less certain about their fundamental prospects, and we will have sold out of those. In a similar fashion, you'll see purchases that are below the expected return of the portfolio, but that's because we're far more confident in the prospects of the company. So you would see a distribution of sales and purchases above and below the portfolio, but the fact that we have so many sales is a higher turnover rate than normal, and they're all below the portfolio expected return. What we're doing is just trying to get that expected return, because we target 12% as the portfolio expected return. As you can see on the chart pretty clearly, we weren't at a forward return of 12% in the portfolio. So we had to really wrestle with that, and a lot of our efforts were focused on really getting the portfolio back up to that 12% target return. Now, as you creep forward into 2022, then you start to see that mix I was talking about. You see sales above the line, and you see purchases below the line. And that's where we started to get into a situation where the expected return of the portfolio overall was healthy, and we were able to start being more discerning on that fundamental basis. And I don't want to imply that we weren't discerning beforehand, but you just look at the volume of activity, and that just shows you the magnitude of the challenge. Like I said, Manhattan, MANH, down in the lower left there, you see 4 sales. That's one that I covered. It's an amazing company. It was one of those that probably merits a 10 times sales multiple or better. Very profitable, extremely sticky. They basically run the back-end logistics for just about everyone but Amazon. So if you want to compete with Amazon, you want to do 2-day delivery, you want to have your inventory all over a 300 store base and know where it all is at all times, and be able to replenish, ship, fulfill, all those things, Manhattan has far and away the best solution out there, and there's no question. They're the premium solution. They sell into, larger, more sophisticated retailers, grocery store chains, things like that. As you can expect, at the top of the market there, if you don't have Amazon and you don't have Walmart, it's a more narrow available market. And so they started to trade at this huge valuation that was far beyond what they could even sell into. I mean, that they were much larger than what we call their TAM, their total available market. So ultimately what that meant is it was capped upside, and we showed a negative expected return. And to see a bunch of our names in the portfolio showing negative expected returns is a pretty rare thing, and I think that itself just speaks to the challenge we faced. And so I say this because then we move to...
Can I, Phil, just one thing,
Yeah.
I get the opportunity to listen to him, and then I'm watching this, and I see these 2 data points that I think maybe worth talking about. So Manhattan was really expensive. Nick did the work on it. It's a great company, but it was way too expensive. We sold it. It went down a lot afterwards. See that dot up on the upper left? SMCI, which is now the largest company in the portfolio by market, because it earned its way there. And we've owned it for a long time, but we added to it. It's a server company. They compete with Dell and Hewlett-Packard. And they've got this hyperkinetic guy from Taiwan was the founder. It's an amazing story, by the way. He founded it. They've never had a losing year. They've never had a layoff, never done an acquisition, and they're now annualizing revenues at $8 billion. But he's got this thing extremely well positioned. They're squeezing out year-over-year revenue growth at around 50%. They're just eking their way to 50%. And this is a company that's doing $2 billion of revs per quarter. They are the leaders in emerging in a thing called AI, artificial intelligence, and they are leaders in storage. They are absolutely on fire, and the stock is now about 8 times trailing earnings, if you can imagine. And it's growing. We're not sure. We're gonna have to see them. We followed it for years. We're gonna do a whole other deep dive to understand what we got. It's done so well. It's causing. That was the. It isn't that we bought it up to where it's at in the portfolio. It just went up 3 times last year, and the portfolio was down, so that's causing some distortion. But it's kind of interesting, selling Manhattan, which is a wonderful company, and buying an emerging star. This is what we do, and this has a big effect on portfolio performance. I just wanted to highlight that because that Supermicro stands out there.
What stands out to me, why did you sell JetBlue when it was up there?
Well, that's it. So what happened was, I'm the analyst on it. So, we're pretty long-term oriented, and we held JetBlue. They are acquiring Spirit Airlines. Are you familiar?
Yeah, they're acquiring, trying to.
I think it's not through the government yet, but they won the first round. But we had long talk with the CEO of JetBlue. It's at least 3 years before, at the time, it's about 3 years, they've got to go through, they didn't own it, they didn't have it done at the time at the corporate level. They got to go through I think it's the FAA or somebody, they got to go through that. And then they got to integrate the 3. It was too far out even for us, okay? And we also had picked up some signs that their customer interfacing had gone down. It used to be great. And so we thought, it's a high expected return, but the resolution of this is out in the future. And so we thought, you know what, we're gonna let it go. So it's rare for us to sell a stock with that high expected return, but it's too far in the future and too indefinite. It's just a judgment call, so.
Yeah, it kind of highlights what I was saying, that, we're in a position now where we have the luxury of better than a 20% forward return on the portfolio. So we're being pretty selective with how we constitute the portfolio at this point. The reason I wanted to talk about all of that was then we go into 2022, and we had basically spent, the takeaway from 2020 and 2021 is a lot of our efforts were very internally focused. I mean, it was focused on getting the portfolio where we wanted it to be, just because of the environment where we were in. And 2022 happens. If you had a balanced account, it was not a great year. If you looked at the fact that we had a down, it was 13% year in bonds, and a down over 20% year, 18 to 20 some, depending on which part of the market you were in equities, in the same year, was pretty brutal. That almost never happened. We went and looked at data back to, I believe, the 1940s. And there's been a couple of times where both stocks and bonds were down, and it was never as significantly down as it was simultaneously this year. So that was somewhat unprecedented, at least in the modern markets here, the post-war markets. On top of that, you flip to the next one. This slide I'm going to spend a little bit of time on because I think this is probably one of the most important slides that describes kind of where I want to get to, which is the end of 2022 and what we're seeing. And also just one of the most interesting phenomena in the market over the last several years. It touches on a whole bunch of different threads here. So what you're seeing is since the year 2000, you have 4 lines on there. The black line is the forward PE, so the next 12 months of earnings and the price you're paying for that. For the S&P 500, which is large cap stocks, the S&P 400, which is mid cap stocks, and the S&P 600, which is small cap stocks. Now, before I jump forward from there, I want to highlight the fact these are all the S&P. The S&P attaches a stipulation to being in the index where you had to be profitable. You guys recall Tesla went into the S&P 500 later than people expected because they needed to get it to a profitable 12 months before they could gain admission to the index. We then also added, it's called the Mega Cap 8. We're ripping that name off from a macroeconomist named Ed Yardeni. You may be familiar with him. He's been around forever. He's a very, very good analyst. But he put together basically what were the top 8 tech companies during kind of the valuation peak. And so that's in orange. It's Microsoft, Apple, Amazon, Google, Meta, or Facebook, Tesla, Netflix, and NVIDIA. And so if you look at them and you put them all together at the peak, those 8 companies alone probably accounted for a little bit more than a third of the market capitalization of the S&P 500. The S&P 500 is typically around 80% of the capitalization of publicly traded equities in this country. So that's a quarter of all market capitalization was in those 8 companies. And they're all tech companies. This isn't a heterogeneous lot here. If you look at that orange line, despite being trillions of dollars in market capitalization, they've approached almost a 45 times earnings number attached to that. You generally don't see that with, $100 billion companies, let alone trillion-dollar companies. And so you could argue, I mean, there are arguments that support an upside case there. I mean, you have to get pretty pie in the sky. They eat the world. They take over Europe and China and a lot of these other markets as well. But we're talking about trillions of dollars market capitalization. You can't just go after small markets. Fred and I were talking last night about the fact that if you took the entire mid and small cap space, the market capitalization of one of these companies probably was bigger than the entire part of the stock market where we invest. Now, the reason I say that is because when you see headlines out there, and this is something we have to sometimes talk to many of our clients about, when people say, well, the market isn't underpriced yet, the market is doing this, etc., that's a big reason the market is doing what it's doing. We're not invested in those. If you look at the valuations attached to the small mid-cap space, they're near historical lows. You can see them down there around 13 times forward earnings. And that's where we drew that little blue circle in the lower right. And that's at the end of 2022. And so what this did was really set up the situation, which is what I'm going to flip to next, right here, set up 2023 here, which is what we're seeing in the fundamental work in the portfolio. So real briefly, I'm just going to set the stage with a big picture on 2023 and then talk about the portfolio because that's where the bulk of our research lies. So here you've got the leading economic indicators. I'm not going to belabor that. That's a macroeconomic indicator. You can see kind of its consistency in predicting recessions over the last 50 years. Right now we're at a negative 6.1%, I think was the latest tick on that. Every time it's reached that level, it has indicated a recession. Whether or not we're in a recession is going to be a little bit of an odd one if we are, because we've got a ton of hiring. People are still rehiring like crazy in kind of called the service, the pink collar, blue collar, whatever you like, industries. So you've got retailers, cruise ships, hotels, airlines, all just restaurants, desperate for staff right now. So you see tons and tons of hiring. That's partially driving the low unemployment rate. You also see a little bit of a talent war still happening in tech. So if you say Amazon laid off 18,000 people, well, during the pandemic, they'd hired several 100,000. And so these are trimming a little bit of fat. These are on the margin of just the hires they made the last few years. And, this is anecdotal, but it sounds like a lot of these people are getting snapped back up. So you are seeing layoffs. You are seeing people being a little bit more parsimonious with their hiring budgets, but you haven't seen anything that would indicate on that front that it's the typical lead up to a recession. So we don't know what'll happen. I mean, every time is a little bit different. It could be a recession. We're not going to predict that, but that's what people are seeing out there. This next one is the last thing I'm going to do kind of on this macro, big picture sort of level, but I think it's a really interesting chart. So it's helpful if you're able to flip back and forth between slide 6 or page 16 and page 19. That was that chart that I Billy said I wanted to highlight with all these squiggly lines on it. What I did here is if you look at the first bar, so there's two groups. There's a 3-year group and a 7-year group. And what these are the compound annual returns during the last 3 years and the last 7 years. So in black, you'll see the S&P 500 is 9.9% for the last 3 years per year. In the orange, I'm going to skip this second one for a second. The orange, that's what our mid-cap product has done for the last 3 years, 9.1%. And in the gray, our benchmark was at 6.4%. Flip over the 7-year numbers here. The S&P 500 did 13.3%, we did 13.7%, and our benchmark did 12.4%. Now that second one that I skipped, that 0.7%, that 9.1%, all I did with that is I took the S&P 500 returns and I said, what if you took this 13 times multiple that smalls and mids are trading at and assigned it to the S&P, which is up near a 17 or 18 times multiple. So you just discounted the S&P down and put it in line. Historically, it has been in line. If you look back over since 2000, the S&P generally trades right in line from a multiples basis with all these other spaces. So there's a divergence that's opened up. And I said, what if that just trues up? Either the S&P comes down or smalls and mids go up. What does that do to that 3-year and 7-year number for the S&P 500? Now what happens, this actually kind of surprised me, I didn't expect this magnitude once I ran the math, was the 9.9% went down to a 0.7%. And so a lot of the S&P 500's performance the last several years has basically been due to a valuation expansion above and beyond what smalls and mids have experienced. Ditto with the 7-year number, it goes from 13.3%, you're amortizing that deficit over 7 years instead of 3, so the drop isn't as dramatic, but it goes from 13.3% to 9.1%. I think that's probably the important number, because if you look over a long sweep of time, that's typically about what the S&P 500 will do on a fundamental basis, because you say the valuation will go up and down, but ultimately what powers long-term growth is that fundamental performance of the underlying companies. That's generally been what corporate America has been able to accomplish, is probably a 7 to 10% long-term rate of return on a fundamental basis. And so that would just bring it back to a return we'd expect. 13 times multiple would be historically pretty depressed for the S&P 500 as well, so I don't want to predict that it's going to go that low. If I had to make a really loose speculation here, I'd say they probably wind up somewhere in the middle. But unless you think that divergence between multiples is going to remain, which I think there's a good case to be made for a lot of headwinds, especially against those big tech companies which are driving that valuation S&P 500, because they're so far above a lot of the rest of the stocks. If you see them up here, that means the whole rest of the S&P 500 is down here, and they meet in the middle. And so I think those big tech companies have really been the story of S&P 500 performance, and a lot of that story has been valuation. So and I say that because that way I always want to establish that what we're doing and what we're seeing isn't contingent necessarily on what you see in the headlines and what you hear on a regular basis in the financial media, because generally speaking, the phenomena they're talking about have been driven by the big tech companies, which we're nowhere near. So now that we've got the macro piece out of the way, I want to actually go into the portfolio, which, like I said, is where we spend the bulk of our research. That's probably more macro setup than we usually want to do. On slide 22 here, we've talked about expected return a lot. So again, we take every company in our portfolio, we model it forward for 7 years on a fundamental basis, and at the end of 7 years, we just assign it a reasonable valuation multiple. It's called a capitalization multiple. We put that on top of the company. We cross-check it 5 different ways. We've run a lot of retrospective studies. Usually something a little over 20 times earnings is probably a pretty normal environment sort of multiple. And so if we arrive at that, and we are right in our modeling, which we do a lot of back-checking on this, this is the chart of our historical expected returns since the end of 2006. And the big takeaway here, as you look back to 2008, we had a forward expected return on the portfolio that actually got up to about 25% as of quarter end. And as of right now, we're above 20% again. We're not as high as 2008. We don't see the market as that bad. But we are seeing one of the best expected returns in the portfolio. And given the fact, and this is part of the setup I wanted to go through, that we have spent the last 2.5 years intensively focused on tuning our portfolio, we feel pretty confident in that 20% plus expected return. This wasn't a portfolio that we just, you go to war with the generals you have sort of thing. This is the last 2.5 years we've really been working hard on the internal dynamics of the portfolio, getting it balanced properly, getting the expected returns, the risk right where we want them. And so we actually feel great right now about the setup that we have going forward. Fred alluded to that at the beginning. The joke on this chart, just as a slight aside, is one of the running jokes at DGI is my highest value out of the firm has been hitting copy and paste. Basically, the reason we have this chart is right after I started in 2006, I realized we had all these great models, that we kept updated in all our investments. We're doing deep modeling and deep research on all of them. No one was archiving them. So I didn't ask anyone. I just started hitting Control-C, went over and created a new folder, hit Control-V. Started out once a quarter, this way you have the chunky resolution. Eventually that moved to once a month, and now we're doing it once a week, and hopefully we'll get to daily resolution here as we roll out some of these new internal tech platforms as well. The mistake I made, though, and this is the reason you haven't seen this chart too often before, is that when you take probably 200 Excel files and you start shoving them in a bunch of different folders, it takes a very long time to go into each Excel file and pull out a number like expected return. You're talking thousands and thousands, sometimes tens of thousands of files, each one sometimes with a cell located slightly differently. So this has been summer's worth of intern projects. Last summer we had 4 investment interns. This was a big part of their job. But we're really pleased to have it, and I think going forward we're going to have a lot better data like this, because seeing this and seeing what we actually did is helping us get better. And what that brings me to is this next chart. These ones you guys haven't seen before. These are new as well. I'm pretty excited about them because I think this really gets to a lot of what Fred was talking about, how DGI works. And so that expected return you saw on the prior chart, this is just the annuals, this is year end. This is the same chart, but it's in a histogram format, a stacked histogram. So what you're seeing here in, say, December of 2006 on the left, you're seeing a vertical line there. It goes up to right around 14%, I would say, on the y-axis. The black part of that line is the fundamental progress we expect out of the company. So that's where we spend a ton of time on our modeling and our work. We do the research on the companies, their marketplace, their competitive mode, their culture. We interview everyone about it. We get as much information as possible, and we filter that through our DGI process. And eventually we come up with what we expect the fundamental progress, how quickly are they going to grow revenues and profits over the next 7 years. That's a partially driver of the return. As Fred said, a value bias is in our DNA, and so we like to buy the companies for less than we think they're worth. So that next part, that orange part of the line, is going to be the valuation discount, and the return we expect from that valuation discount truing up and going away as the market recognizes the value of what we purchased. So we drive some of our returns, and historically this has proven to be the case. We get probably between 8 and 10% of our returns every year. If you say we target 12, we've hit 12 or 13 historically over time. 8 to 10% of that has been fundamental growth in the companies, and the last few points has been a little bit on dividend, usually a point or two on dividend, and then the rest is that valuation true up, that convergence we call it. And so that little gray stub you see on the top, that's what we expect to get out of dividends. And so if you go through time, you'll see the thing I want to call out here is that black line is really stable. I mean, generally speaking, we've expected fairly stable, consistent growth out of our companies. You do see it move around a little bit. I mean, coming out of 2008 and 2009, you see it decline a little bit. Some of that was, rotation within the portfolio because there is trading that happens underneath these numbers. Some of it, though, is, you had impaired end markets. We did own, as an example, we had gotten rid of almost all our financial exposure in 2007. We did still own E-Trade, as an example. E-Trade was not the company it was before the downturn. They bought a whole bunch of MBSs in Nevada and Florida, and they just destroyed their balance sheet. And I think we got diluted down by Citadel to the tune of about 99%. So there's not a great outcome on that particular investment, but there were a few like that as well.
Let me just add some qualitative comments. There's a lot of glamour in theory in our business, all these hedge fund people buy sports teams and stuff like that, but the real part of the business is just hard work and diligence and focus. So when COVID hit, again, we're mission-based. When COVID hit, Rob and I had a discussion, and I'm an old guy, and so I'm threatened from COVID, and Rob's immunocompromised. So we said, you think we should be in the office? Well, we're not riding public transportation, we have a small farm. We said, yeah, we're going to be here every day. And 2 of our youngest analysts, they're wonderfully talented young guys, they're saying, shouldn't we be working at home? We said, you can work at home if you want, but we're going to be here. So they got elected to be there. And we were very conscious of, like, Nick had a baby, not Nick, but his wife did.
Yeah, I did all the work.
During that time period, and he was, he took,
Yeah, that came in right after July 4th. She was born on June 4th, which is the heart of the riots in Minneapolis. And then a month later, that's when I started coming in.
So, and Jason's daughter had some respiratory issues. Come in when you're comfortable. But so here's what happened. So we're in there. We realized we got to really step our video conferencing stuff up. So we really stepped our video conferencing up. We started calling CEOs. Here's what we found. It's kind of funny. CEOs were home like all the rest of their employees, and CEOs love to talk. So We had
Really?
80-some, was it 80-some conference
Oh,
calls?
yeah, I think we got to 85, we were keeping a tally.
We were getting all
This
this
is in one,
unbelievable
like,
access.
4-month
And we were
stretch.
seeing how they were handling COVID in real time, how you're handling, employees and stuff like that. And it gave us a tremendous look at how the company was operating. We also really, kept dialing in on this idea of, for the first time since '08, we had overvaluation on some stocks and our expected return was below 12. That's like, a warning light for us. So we made changes. But I have to tell you that where we sit today and what this is close to proprietary, just because we have all this time series data. So we're saying highest expected return since '08, not as much systemic risk, because '08 was the big one. The financial system almost immigrated. Really high, and we'd see it in the price-earnings ratios, where, we can argue for increased valuation on our stocks. And we're just so diligent about it, and we've got, it's the best-looking portfolio, top to bottom, I can remember. And that's a combination of really good companies, and the stocks are well priced. So we're like, we don't know if there's a recession or not, but you gotta be long these stocks because the companies are too good, the stocks are too cheap. Pretty straightforward, but it's a lot of work to get to that, is my point. I don't know if that makes any sense to you. You don't just go out and find a super micro, or you don't find a Plexus, or you don't find a microchip. Those things don't just, drop in your lap. You gotta go out and dig, and you gotta do all kinds of stuff.
Well, given what happened with Robert, given what happened with the portfolio and how much work that was, I've told people that in my life, between having a new kid and everything that was happening at the firm, COVID was actually really just background noise. That was like number 3 or 4 on the list of things I was worried about at that point, because it wasn't something, I have peers who occupy similar roles at other firms, and I talk to them, compare notes. And by and large, everyone went remote. They started working 6-hour days. Part of that was because you didn't have to spend much time talking to each other. We've talked a lot about culture, and I've talked to Fred about this, but he said, but doesn't that sabotage the culture? And I said, some of these places actually help the culture because they all hate each other. So the fact that they didn't talk to each other meant that the culture improved, and they could get all their work done in 6 hours instead of 8 or 10. And so, good on them. It was a boon, I guess, but we were in the office, and I was trying to deal with, no sleep with a new baby, and all the work we did in the portfolio, all this stuff, it was a lot of work. The last few years were exhausting, and then you load in a few personal tragedies and some other stuff, and it was quite a stretch. And so the fact that we're seeing this setup is really gratifying, because, spending a bunch of time in 2021 selling stocks because they're overvalued, and the first thing they do is go up another 50%, it's professionally very frustrating. And so now seeing the far side of that and seeing what comes of it, we saw it in 2008. We're starting to see the glimmers of it again right now in the market. And Fritz, thank you for that, because you're a great straight guy, because my next slide, I'm 25 here, and I promise I'm near the end. This is one of the ones that I think is it's so important in terms of this time series data I have been showing you. Because we have the intern bandwidth and we got the systems now in place, what we did here is there's something we call the model portfolio. So we manage a lot of separately managed accounts. When an account brings in cash or takes cash away, etc., we try and keep them on the model. We look at the target allocation percentage invested in each of the stocks as a percent of the whole in the portfolio, and the way we maintain that is we have a phantom portfolio. This phantom portfolio, though, trades alongside our clients. So it's in the trading system, so when we conduct a trade, it achieves the same prices upon that trade that our clients do. So even though it's not real money, it's basically traded in line with the portfolios. It has similar performance characteristics and everything else. The reason I use it here, and this is really important, is because there's no cash flows into or out of the portfolio. So everything you see within that portfolio is due to investment decision making and the performance of the underlying companies. And so if you look back in 2006, there are a certain number of shares owned in that portfolio, and each share owns a slice of the pie for each company it's invested in. So in 2006, you see that black line. What I did is I went through the model portfolio and I took every share we owned, said what are the revenues per share and what's the EBITDA, the profits per share, and then just added it all up. And so back there in 2006, you wind up with probably about eyeballing it here, $18 million worth of revenues owned by that portfolio, and probably about $2 or $3 million worth of profits in that model portfolio. The numbers themselves don't matter relative to your portfolio or other clients' portfolios. What matters here is then the progress you see over time. And so by the time we get to the end of 2022 here, because of the partially investment decision-making, but we only turn over 10% or a little bit more of the portfolio per year. So primarily due to the performance of the companies we do own historically, you saw that grow to nearly $120 million in revenues from that $18 million. And you saw it grow to probably about, how does that work out to, $22–23 million worth of profits. And you see the compound annual growth rates over on the right-hand side there. So we have the since inception number and then the last 7 years, because again, that's our modeling horizon. That's where we cross-check our modeling work, saying this is the fundamentals of the overall portfolio. So if you think of your portfolio as a conglomerate of 40-some companies, and you just put them all together and say, we own a revenue stream, we own profits, because we like to think of ourselves as investing in a business. We're not speculating in and out of stocks, we're owning a business because of the fundamental growth potential in those businesses. This is what we've owned over time. And we haven't had this available before, because again, as we get some of these new data systems online, this is the sort of insights we're starting to see. We're unpacking, what do we do next with this sort of analytical insight. But I think that this is a really powerful chart, and if you move to the next page, if you flip back and forth, they're oriented in the exact same spot. So look at those CAGR, the compound annual growth rate numbers. You see EBITDA has grown over 7 years at 17.3%. The intrinsic value, that's what we think the portfolio is worth, has also grown at 17.3%. Similarly, since inception, EBITDA has grown at 15.3%. Our intrinsic value growth, what we assess the portfolio to be worth, has grown at 15.4%. So our valuation of the portfolio has been remarkably consistent, and since 2006, it's been supported by fundamental growth, which is what we want to see. That is the engine of value creation over a long period of time in our portfolio with our holding periods. The orange line on that, so you see what we think the portfolio, that model portfolio is worth, is in black. So we think it's worth a little over $300 million right now for about a $120 million revenue stream with stable profits and growth prospects. The market is the orange line. This is what the market thinks our model portfolio is worth. And on top of each of these bars, you see the discount that the market, from our intrinsic value, the discount to intrinsic value that the market is showing. That's that orange bar if you go back to the sources of expected
It's
return.
really got big right here.
Yeah, well, that's because it's not on a log scale. It's actually growing. It's because you see that accelerating curve because of compounding. There hasn't been, it's a step up, but percentage-wise, it's pretty consistent what we've seen if I put this on a logarithmic scale. I think the one thing I'd call out here is back in 2008, you see a 63% discount to intrinsic value. At the end of 2020, you see only a 3% discount. It's a little misalignment, so that orange line, as it spikes up there, that's the valuation problem. We were pretty much right on our intrinsic value assessment, so we had almost no return expected from any valuation behavior. We've got it all up front, and that's one of the reasons we were moving capital around. And right now we're at about a 45% discount. The market is pricing a 45% discount to what we think the companies are worth, and that's why we see such powerful forward returns. We still see great fundamental prospects, but a big chunk of that forward return profile is because the stocks are just so cheap right now. They're the same companies. They have the same great long-term prospects. I mean, unless you think that this downturn is going to put them out of business, which the past downturns have not, we think that, and we've done some serious work on this over the last 2.5 years, we feel really good that they're going to be around and they're going to be thriving in this environment. So whether or not there's a recession this year, which we spent a lot of time at the front end talking about, all of that, we're looking through that. I mean, that's what our 7-year modeling horizon enables us to do. We're saying, with the reasonable set of valuation assigned to our portfolio, and with just reasonable expectations on the fundamental progress that we have historically modeled and seen in these companies, because we're owning the same companies by and large, we expect these sorts of forward returns. So given the recent amount of diligence we've put in, given our track record of being decent at doing this diligence, given the fact it's the same people and largely the same companies, and you put all these factors together, so when we see and expect a return that's near historical highs, in this case, we feel pretty good about underlining that with our clients and going out there and saying, this is a really important time right now. So I'm actually going to breeze a little bit past this slide. This is a little short-termist.
Let me just,
Go ahead.
Nick gets so, this is phenomenal analytical stuff, by the way. After Nick got his MBA, then he wasn't satisfied. We paid for additional training, so he went back and got his master's in financial mathematics, right, at night. We actually have a program, by the way, where we actually don't announce it, but when somebody like goes in, like Nick did, he's killed himself tonight going back and get his master's. You got a huge bonus. We paid you a cash bonus when you got it.
We've done that for a number of people.
Yeah, just, it
Haven't
was
got
sizable
one,
too.
yeah.
It was sizable because I'm thinking to myself, in the middle of the downturn, 2008, one of our employees who was going back to college, she kind of came to my office and she said, is our tuition program still intact? I said, that's the last thing we'll cut. And She said, why is that? I said, because you'll run out of energy before we run out of money, you know, because like Nick did his at night, right, you know? And so anyway, this is a kind of, what I'm trying to say is we're continuing to analyze ourselves. We keep looking at it, trying to understand better where we are. I was just curious, Nick, and I'm looking at this too, you know, our 7-year annualized growth in EBITDA is really high, but the portfolio hasn't done that. But I think what happened is the multiples went down.
Yeah.
And there's again, when you think about margin of safety, you want a high expected return with reasonable assumptions. Does that make sense? So we got a real chance of intrinsic value growth actually being higher than we're budgeting. Because when we look at our companies, they're incredibly dynamic. And whether it's beyond Supermicro, we have 2 other companies that are right in the middle of the AI revolution. Okay, so we have really dynamic companies in there, and so we may actually do better than that. But we don't want to base our decision on that. We want to base our decision on achievable results, and come in to say, look, we have a really high expected return. Under reasonable assumptions, but there's a very real chance that our companies will substantially, just to give you an idea of Supermicro, which is annualizing at about $8 billion of revenues. You know, we talked to them a couple weeks ago, that the server market's $100 billion, so they're doing $8 billion. So we said, so what part of the market do you think you address? About $60 billion. And because they are at the leading edge of the technology, they're not having to replace an existing facility, right? So they're coming in on new applications, so they don't have to tear out the old. So it's pretty, you know, it's pretty spectacular growth, and it's 8 times earnings. So you could make the case that it's going to grow a lot, and by the way, the founder that has built this thing up, 2 years ago, cut his salary to $1 and loaded himself up with options. He's already a big shareholder. I think that was a really smart idea, because he's playing for the stock to go up. So my point is, we have some really dynamic companies in there, and with high expected returns.
So I'll go past slide 28 here. The only thing, in case you're curious, we show is the performance during a downturn, what we do in the next year after that. That's the decline from the peak, and then what we see in the first year of recovery. I don't want to dwell on this because it is a little bit short-termist, but it's to reassure people, usually when there's a market downturn, you also get a snapback. These valuation pieces bounce around a lot. And I'm going to get to the last point and a half that I'm going to make here, which is this slide 29. We've been working through our bullet points here. I didn't make a slide for this innovation. That's in part because I haven't figured out how to visually represent it well. We've actually had internal debates, we've made infographics, we've talked about it a lot, but it's such a big concept, it doesn't lend itself way to a pithy graphic or a pithy chart. The one thing, and I did this yesterday as well, so I'm covering old ground with some of this, but I want to say, when you hear innovation, we separate that from invention. Invention is coming up with a new idea. Innovation is when it percolates out through the economy. And I think that's a really important differentiation because a lot of what you think of when you think of innovation, you'll think of a company like Tesla. You'll think of companies in Silicon Valley who are making really nifty new software tools. You know, they're putting stuff up in the cloud. If you think about all those things, though, they are tools. They have to go and be applied against real economic activity. And so the innovation piece of it is oftentimes when you push that out into the real economy in a fashion. And so if you look across our portfolio, a lot of times these are not the companies you would associate with, you know, Kathy Woods buying it in the ARK fund, for example. You know, this is going to change the world, et cetera, et cetera. This is where the inventions actually come into their commercial applications, and you attach a profit margin to every application that you put that invention into. So this innovation, as it percolates out, you look at the energy sector, you look at what's happened with fracking, and you look at what's happened with organizational controls and systems within that, and the profit margins, the sustainability that drives. You look at what's happened in supply chains and logistics. You look at what's happened on manufacturing floors. When you take AI, which is an amazing technology, I mean, it's a very big concept. There's many different types of AI. But if you put that in there and you drive machine vision, and you're manufacturing everything from semiconductors, which are too small to see if you've done it right, but you put a camera in there with really intelligent machine vision, you can verify it while it's going 60 miles an hour on a production line. You can also do that with Coke bottles, make sure they're filled all the way to the right level. And if you think about all the different things that have to pass over either a belt on a production line or in a sorting facility for FedEx, you say all of these things need to be read and understood and scanned, and there's trillions of objects going past every year. And if you can take just a few cents of labor out, generally you can do a lot more than that for just 1% of the overall project cost of building the facility in the first place. That's the sort, and you use AI to do it all, so you don't need people attending to it, and it's more reliable, it increases your yields. That sort of economic benefit, the company I'm referring to right now is Cognex, it's one of our portfolio holdings. But they do industrial settings, but they're using AI, they're using machine vision, and for quite some time, Wall Street covered them with industrials analysts. I mean, they basically are the same people that were doing machine presses and things like that. And that sort of analytical assignment, the sort of sector categorization that you see out of that is oftentimes what creates these opportunities, because they weren't seen as, one of these Silicon Valley, heart of the valley, amazing superstar innovators. And here they were taking things like artificial intelligence and the cloud and pushing them into a manufacturing setting and really driving a ton of economic value creation. I mean, not just for themselves, but for all their clients. And so you look at that sort of innovation and that sort of ability to take these next ideas and put them into a commercial setting where they actually have a real impact. It's not just this hypothetical where you pay 10 times sales for a negative 200% op margin, but they have a really cool platform that they're out there selling you. This is where the rubber meets the road. The economy actually grows a lot. And so that's the sort of innovation that we have in our portfolio, and that's a big driver of what we see as the fundamental value creation. And we can talk about this on a specific stock level. I know we've already run to just about an hour here, so I don't want to take too long on that. Happy to answer any questions. I love talking stocks. Fred knows I'll just go on for hours if you let me. It's my favorite part, so I did want to get at least one in there. So Cognex is the example this year. If you have questions, I'd be happy to talk about some others. I know we've covered some in the past.
I've got one question. Obviously, you're talking about innovation and sort of the enhancement as well as the disruption that creates, right? You have new customers coming in, competing against old, maybe slower, less capable firms. So from a portfolio standpoint, obviously we want to be attached to the innovative, profitable disruptors. We also want to make sure that we're cognizant of, okay, what's going to get blown up and disrupted that we need to be cognizant of. So I'm not expecting you to go through the entire portfolio, but I mean, as you would. But as a general working theme, how would we be looking at, how do we avoid traps, investment traps?
Yeah, let me take a crack at that.
Okay, we'll both-
we have opinions on this. It's a very, very area of high ferment for us. What I was going to say is a big chunk of it, I think, is the culture of the underlying firm. I mean, if you put a firm in there and you're putting the best of breads, you attract talent, and they're sitting next to the big problems in the industry. You make sure they're highly motivated and engaged with it. They're going to spot those disruptions before we're going to. And having them engaged with that problem, there will be parts of the business models that get blown up. There will be structural areas, the innovator's dilemma, where the company is just too embedded in the old status quo way of doing things where all talent in the world can't save them. They can't make the switch. And it's our job to look out for those. We're not going to be perfect, but we do spend a lot of time on that. But I think ultimately the ability to adapt to that changing world is why we emphasize culture so much. I mean, you might not see culture really manifest in a returns fashion year to year, but over a 10-year period, especially with a company like Supermicro, I think you start to see the impact of having people who actually do a really good job figuring out what the future holds and innovating against it and driving that innovation. And so that's where we start to see that cultural question become very important.
So how do you evaluate culture?
I'll let you take over from there. I have opinions there too, but I'll let Fred go.
So there's a, for better or worse, I would call it an inside-out way to think about things. So we have a strong culture. We do a culture survey with an independent every other year. We've been, I think, one of 2 firms out of 100 plus that have been at the top 3 or 4 for over 10 years.
Jim Ware's Focus Consulting, if anyone's curious.
And so because we struggle with it, one of our key questions for CEOs is about culture and how you're developing people and where you're going to take this place, okay? Because it's real. And let me extend it when you think about innovation. You get some companies that, well, not some, the ones that we've been looking at develop a culture of innovation. And we've had internal debates on this, but one of the companies we think is one of the most innovative companies in the world is a company in Olathe, Kansas, of all places, and it's called Garmin. I've got my Phoenix 6 watch here. It's just an amazing company, and they have a culture of innovation, and I haven't seen very many companies that can bring in a variety of different industries, can bring the proliferation of new products that they can, and they have, there's a lot of sort of in-deep understanding of innovation. So that you'll find that there'll be a clear culture if you go see them of innovation, and it gets infected all the way down. Okay, it starts at the top and it works its way down. Now, about 12 years ago, we decided that innovation was both an opportunity and a threat. So we started asking questions of our companies. How are you handling innovation? How do you think about it? You know, and it's certainly a threat these days on internal controls and distribution systems. It could be a threat on products. So then you get into the real world, which is innovation. Often it's a good rule to remember that most major innovations start more slowly than expected and end up being much bigger than expected. And there's actually a stock market phenomenon, which is in the early days of it, the stocks go way up because everybody sees the promise. Then you get the reality of the business, they collapse. And then that's the fertile time to invest. And you can get massive misperceptions, massive. In '02, the consensus was you could not make money off the web. So Google, Amazon, Apple, all those people could not be a success. That was the prevailing wisdom on Wall Street, okay? Well, that turned out to be wrong, and the stocks were cheap. So you have to look at it, and you're right, John, you have to look at it both ways. Now, it requires us to also be really open to, we have a heroic company and they've done well, but they're getting displaced. And we have to be open to saying they're getting displaced. And that's a hard thing to do, right? Because you're invested, it's a big stock. So you have to keep asking that question. In my opinion, often it's the questions you don't ask that determine the outcome. Just as an example, this is an article of faith with us. Whenever we interview a CEO or a company, we always ask the last question. Is there anything we haven't asked you yet that you'd like to put in our heads? Is there anything you got, we're closing them, this is our last question, we do it every time. Is there anything that we haven't asked you that you want to tell us? And we get a lot of interesting, answers. They'll say, it's funny, or you didn't ask us about this, or this one in my mind, so you get another little. But framing this and saying that innovation was going to be a huge driver of results, and it's a lot of the basis today of our optimism about our companies, even though there's all kinds of macroeconomic, storms out there. But innovation is so pervasive, and we've been talking to our companies, seeing how they're doing it, and we can't really quantify it, but it's real, and it's coming down the pike.
If we can't quantify it, I'll get you guys a chart. I'll figure
Nick
out
will
what
figure out how to quantify it,
We'll let you charge.
Yeah.
but it's a hard one, okay? And we're asking you not to just think about it as just products, but it's internal controls, distribution systems, and also understand that you might be, fat, dumb, and happy today, but there's somebody out there going to eat your lunch, okay? So I think it's really important to understand that if you're a long-time money manager, you have to be continuously open to learning. I've done this a long time, but I'm trying to learn. I'm trying to get better every day, because because there's new data, and we might have, like I said, a stock we just love, and they're getting their lunch eaten, and it's up to us to accept it, move on.
If you see the value, don't others? Do you put any value on the prospect of an acquisition, or takeout, or I mean, how do you attack the,
Yeah.
That's a really sore subject.
Oh, well, especially for me right now. There's a company in our small cap product, iRobot, that Amazon's trying to buy. And, you know, I have known Colin, the CEO, since I think like 2010. And we've been a large shareholder, so I've gotten to know him pretty well. And when he pulled the trigger and sold to Amazon, I was just livid. It's a $61 deal price, and the stock's trading at $41 right now. No one believes that the FTC is going to allow it to go through. I don't understand the case they're going to make. But we do have to look at that, because that's a reality of the marketplace. On the far side, like, you know, in terms of seeing the value, another one, Viasat, that we own in both portfolios actually, so it's in your mid-cap products, it's a medium-sized holding right now. That one's been frustrating because the valuation is a little above break even since we bought it, but when I say since we bought it, that was back in 2006 through probably 2012 was a lot of the purchase period there. We've added to it incrementally since then. What they do is they put up these very large geostationary satellites, and because they're vertically integrated in the industry, they've been able to bring way better technology to the satellite industry. They're putting up multiples of what's available in terms of bandwidth in the sky, and so basically all the in-flight communications. So the reason you get free Wi-Fi on a flight now is because of Viasat. They're selling into the government. They did a walk-on, and without a contract being out for bid, they won the entire VIP fleet, including Air Force One for the U.S. military. It was a multi-$100-million contract. They just showed it to them. They said, wow, this is so much better than anything else out there. They converted the whole fleet without even bringing it to bid. Now what's happened is you've also got Starlink. And Starlink is Elon Musk and SpaceX, and there's a lot of hype attached to that. And my favorite thesis from a Seeking Alpha article in December of 2020 saying you can't go long Viasat, you can't buy Viasat, or go long Starlink, but you can go short Viasat. And so that was the thesis to short the stock. If you look at Starlink's business model, the economic value add versus Viasat, they don't even necessarily address the same market segments entirely. And what Viasat's done, the CEO there is just incredibly dynamic. He's brought in a ton of talent, and they've been innovating against the industry. They actually sell componentry to Starlink, so they know what's happening throughout the entire industry. And the reason I bring that up in the context of the M&A question is because they went and this last summer sold a small division, a little, I think it was roughly 20% of the revenue stream at Viasat, and it was unconnected with satellite communications because they have a government contracting business. It was line of sight communications on the battlefield because they manage waveforms and encryption and things like that as well. They sold that to L3Harris for almost the entire market cap of the company in cash. And yet the stock still, they just got receipt of the cash. You know, they've got probably a little bit more than that in debt, so the enterprise value is larger. But it delevers the company like crazy. And they're able to sell one small portion of the company for that much, yet the market isn't recognized it. So from an M&A standpoint, oftentimes those are the people who go inside the data room. Those are the people who are going to have really good insight into the prospects and the profitability of the company and the fundamental value of what's there. But sometimes the market doesn't even pay attention to that. And I've talked to analysts on Wall Street and Viasat, and one of them just downgraded it to sell. So do you not think this is going to work with these new satellites they're putting up and all this? So they go, you know, no, it's a great prospects, you know, in 2 years. The next 12 months, they're going to be cash flow negative, and that's enough for him. So even for a lot of people on Wall Street, they see the value, but if it's not within that 6 to 18 month time frame Fred was talking about, it's not going to drive transactions. The stock is just losing money for the next 6 to 18 months. And so the M&A, it is a part of the market. We have to pay attention. It doesn't underwrite our thesis, though.
but the delta between your investment value and the market value could be a measure of what the takeover value is.
Oh, yeah.
Yeah,
That's
this
why it's a
is
sore
why.
point. So if people say, what do you like? We said, well, we're actually like a private equity firm. We build probably close to proprietary, very detailed 7-year models for every one of our companies. And that's where we spend a lot of our time. How realistic is it? How are they going to get there? So when we get a company acquired, we can tell you what the acquirer is getting as an expected return on the stock. And if it's high, we vote against it. And we had this happen with Poly, which was acquired by Hewlett.
Yep.
Okay, and so they stole it. We were giving up a 20% expected return. So we called the company, and the CEO gets on, and it's got an interesting conversation. We said, you know, look, it was a premium to the trading price of the stock. But we said, but we're going to vote against it. He said, well, you're the only people voting against it. Well, that's, so what? He said, so what are your assumptions about the future? And we laid out what we put in our model to get a 20% expected return. He goes, yeah, that's what we think.
Yeah.
And I think the message there was, he was a fairly new CEO, and I think, and it's a long story, I don't think their board was very good. And I think he just I think they overrode him and said, you know,
Sold the company out from under
sold
him.
it. And this has happened before, it happened in small caps years ago. So it's really a sore point for us, because the problem is you lose a really good company, and if you lose it at too low a price, you gotta go replace it.
All that work is gone.
You know, and so you get a sort of one-time, you know, kiss in the portfolio, right? Okay? But we gotta go find some other one. And so we have very mixed views of in general, this happened in small caps years ago, we had a third of ours, for a 3-year period, a third of our companies were acquired. And it hurt our numbers. You know, so you think it would help, like, oh boy, isn't that great, you get a.
Twisted dagger too, you always get like a congratulatory email or two coming in from your market contacts and everything.
Yeah,
Like, all right,
well,
you got
way
a
to
buyout.
go.
Like,
It's like, no, you don't understand, we just got stolen from. And it is what it is.
oh,
But,
you go back and look at Toomey, that was another one that
Oh, we're
got
still
bought
mad
by
about that.
Samsonite.
Hoover's
If you-
handbook,
You look at the voting record on that, and it's a public record, 97.5% of shareholders voted in favor of the acquisition. I mean, almost to the share, it was just us that voted against it. Everyone else just got a
They
rubber stamp, so
stole
they're
it.
like, all right, I got to take out.
it just happens to be our perspective on that. And, you know, we, you know, but I want to, it's funny, when we wrote the book, people said, why would you give away your secrets? I said, that's easy, because here's the Achilles heel to how we do it. And that is that we have a company we think is worth this, and the stock is here, okay? And we use a 7-year time frame. We have no control whenever that trues up. And it doesn't, it's not a linear, you know, you don't like true up, you know, catch, it's not like a bond where you pick up every year. So we'll go 5 years, and then the thing will go up 3 times or 5 times in year 6.
Oh, like
Everybody
Super
goes,
Micro.
yeah, everybody goes, yeah, wow, way to go. And I think it's just, I'll tell anybody how to do it, I just think it's too hard, because it takes a lot of patience, and the reality is, we have no control over that, and we understand that. And we're really lucky that our clients, we've done this long enough and well enough that folks like you say, okay, we'll trust you, but it's not easy.
Well, that goes back to your initial talk there. This is making the business support our ability, and that includes the client base, support our ability to make these multi-year investments and tolerate that sort of interim volatility.
One of my favorite stories, and well, I'll let you go, but.
We've got probably about 3 minutes before you guys.
Well, here's a
It's a-
quick favorite story.
it's a
In
fun story.
1998, we
Yeah.
identified this personal computer company. It was kind of obsolete, and they had all kinds of management problems, and they fired the CEO, but he came back. So we started buying this company in 98, and we finished buying it in 02. And it was really cheap stock. We paid less than cash on the balance sheet and their land, okay? And at the end of 4 years of 02, we were 21, after 4 years, we were 21% below our cost. And we were kind of getting jabs, you know, like clients like saying, hey, you know, how about this? And the company was Apple. Our last sale was up 100 times, okay? But 4 years after we started, we were 21% below our cost. So my point of view is managing money is not easy. You gotta be disciplined, you gotta structure your company right, and you know, it's nothing easy about it. But if you're gonna be good at it, you gotta work at it.
Wait, any more questions before we continue?
Just
But it
one
has
as a
been-
curiosity, you go back to your hiring thing. You
Yeah.
tend to
Well, it
hire
went
to
up, well, it went
recruit
down.
the MBAs or the business guys, not the technology people, right?
Well, yeah, ultimately, we're gonna use technology to make good investment decisions. So what you want is people who are certainly technologically literate, but ultimately, the way to think about innovation and technology is, can you commercialize it? Does that make sense? And can you commercialize it when the stock price is attractive enough so we as shareholders can get the benefit of that? And that's a real simple way to, yeah.
So we had one other item before we
Yes,
take
please, go
off.
ahead, yes.
This is a modification request or an exception request, because periodically we've had usually it's a position size exceed the cap established by the investment manager instructions, or the IPS. You guys have been great in the past. You provide us the exception. It's just an administrative quirk that we go through every now and then. I think super micro has probably bumped up against that recently because, again, a lot of the portfolio went down while super micro is busy going up a lot. So that put it up near 9 or 10%. So we went through, and we're actually doing this, especially with Nick Iceland now on board, our new Director of Institutional Relationships, because several prospects want language both around position size ceilings and around kind of sector exposure ceilings. And so what we want to do is we went back and did a lot of historical work to say, what is language we're comfortable with that really reflects, we're not going to trip exceptions. We're not doing anything differently. This just, we looked at our past and our exposures. And so the two things, and it addresses both the investment manager instructions and the IPS that we put in this letter as a request here, was one, that there's a modification of the market cap several years ago, just because of the size of the opportunity. We usually want to see companies that can go up 10 times. And we said the mid-cap space is really, the place we see the opportunity in a market capitalization sense is between 1 and 15 billion. That's a modification from when Fred started DGI at 1 to 10 billion. So we were requesting that modification. The other one from a sector weighting standpoint, just because you look at energy, for example, we have large positions in Coterra and Southwestern. In that sense, I believe the sector exposure got down to 2% or less of the index. So using the index as this dynamic cap would have precluded us from making those very successful investments because of the fact that it just crushed down to de minimis amounts of exposure. So what we wanted to do is look at it and say, what has been kind of a stable measure of making sure you still have a diversified portfolio, but you also have language that kind of addresses this problem. And so we looked at the super sector categorization schema as defined by Russell. And you had three super sectors within the economy. Information economy, which is IT and telecommunications. You have the consumer economy, which is the consumer discretionary, financial services, real estate, and healthcare. Finally, you have the manufacturing economy, which is energy, materials, utilities, consumer staples, and industrials. What we found is when you put those sectors together, that you don't have something like energy becoming too low where it functionally is off limits for even investing for us. It keeps it together because manufacturing or another materials will create still that headroom to make these good investments. And historically, we've been nowhere near breaching any of those sector exposure limits at 2/3 of the economy apiece, because both our portfolio and the economy have never approached those caps. So we put that language there, so that gives you kind of a blanket. It's not just addressing one sector with a ceiling or anything else. This is a general sort of restriction. It's also something that standardizes from our perspective. We can go and say, if people are sensitive to this topic, generally we don't invest against sector exposures. We look for really good companies in a bottom-up fashion. But this is something that we can actually promulgate with our clients if they need it. And so we did a lot of research around this topic. The last piece too is the concentration, so the position sizing. The shall not exceed 5% at cost. We actually have an internal limit of 4% at cost, so that doesn't make a difference to us in the portfolio. But then 7% of the portfolio market value. Like I said, super micro, we've gotten the exception, but it's in violation of that ceiling. We haven't had positions go above 12%. That gives us a whole bunch of headroom as well. And so this is, again, not a change. This is just getting rid of the fact that we periodically have to do exception requests and follow it through everyone. And then it's the same sort of super sector concentration language as well within the IPS. And so we wanted to put that in front of you. Again, we've been functioning fine for years. This is not an urgent request, but as long as we have everyone together, we wanted to get it in front of you. This kind of just puts in writing what we already do and gets away from saying your IPS says this. We've been doing this for 40 odd years now, and what we've been doing the whole time is just requesting exceptions when we need them. This just kind of formalizes what we do anyways, so it's in writing now. So if you guys, I don't know if you have anything to say on that, we put it in writing. It's a letter, it's not an urgent topic or an urgent request. We've been talking to William about it over the past year, so we had it all put together. Nick, I believe, has talked to you a bit on it. We had a conversation a couple months ago. So if you guys want to review that, we've got a signed letter with us. We can approach the topic now or whenever you guys like.
Okay. Well, go ahead, I think, discuss it in the rest of our meeting here and so forth. So anyway.
Great. I think we can leave you with that then.
Jim, thank you very much for your time and long service to the pensioners here in City of Gainesville. So thank you.
Awesome.
All right.
I really appreciate you guys having us down again.
All right. Very good.
Good luck with the rest of your meeting.
Thank you.
Well done. Thank you.
Thank you. All right.
So you're sticking around for a couple days until the snow abates in Minneapolis? So you
No,
head back
well, I
to-
mean, it depends what Fred gets to fly back. I have to go down to a meeting in Sarasota
Oh, of course.
now, and then I fly back on a red eye tonight, so hopefully they've cleared the runway, otherwise my wife's gonna murder me because my kids are all shooting at each other right now. So I'm going back to the war zone.
Joyce.
Yep.
Thanks, sir.
Thank you.
Thank you.
Safe travels, guys.
See you.
Thank you, Fred. All right, take care.
Can we take a break for a nap after?
Yeah, absolutely. We'll take a 3-minute break here. Anyone need a rescue break or anything? We're good. All right? All right, next on the agenda, let's see here.
I forgot my cup, but I don't need it. I'm just.
We'll take care of it.
Leaving it there.
All right, very good. All right. The floor is yours.
Good morning.
Good.
I guess since they just brought up the whole IPS thing.
this?
Yeah, that's what I was gonna
Okay.
just sort of mention. So in the initial conversation 2-3 months ago, effectively their first request was to just essentially eliminate all the caps.
Right.
And I had a conversation with Nick, fairly extensive, to say that probably isn't realistic, but can we come up with something that would apply as a hard limit, but that doesn't constrain you in a way that would, limit the portfolio. And so after some back and forth, this is, looking back historically at what they've done, this is what they were able to come up with. So from my standpoint, when you consider this applies to 10 or 11% of the portfolio, so even if they have one stock that's 12%, you're talking about at most 1% of the overall.
Right.
It's still very reasonable. So from my standpoint, I'm very comfortable with changes like this. But if you're not, or if we want to potentially do some other things, that certainly would be fine. But just from my standpoint, I think this is very, and quite frankly, we're seeing a great increase in these type of requests, large cap, because of the weightings of those. If you go back 15 years, you didn't have companies that were 10% of the index, but now they are. And so if a manager wants to be even close to index weight, you have to go back and make modifications. So we're seeing more of this as the environment is changing.
Win, you got any problem with that?
No, I mean, their original request, what I think we wanted to avoid was having them become a sector fund.
Right.
And have 90% in the technology sector. The way they've combined it here to form these sort of
Are they doing indirectly what you don't want them to do directly?
no, I mean, with a 66% cap on these super sectors they've created, I mean, to be fair, they don't have anything in telecommunications, they rarely do, but so really, even though they're calling it an information economy sector, it's still the infotech sector. But that's fine, 66% is, that's more than double the index weighting, but, that's their specialty. And, if you believe in their processes, which I think we do, then you let them do what they do best. And I think that's one of the things they do best. So we're okay with it.
You need a motion?
Yes, please. The motion to accept the proposal, agreed. Well, how do you want it this way to?
Just the recommended or the requested exceptions that DGI has made.
Very good. Good. First, we have a second. Any more discussion? All in favor, please say aye. Aye. Opposed? Great. Thank you very much. Great.
So we've obviously been talking for a while. I'm going to do my best to go through fairly quickly, but do have a couple items that I want to point out in the quarterly book before we get to the flash. 10,000 feet, as difficult as fiscal '22 was, and the issues that we talked about certainly with our equity exposure, lack of sort of traditional alternatives, lower real estate allocation. Certainly the returns were impaired last fiscal year. We had some lengthy conversations saying, we understood this, it will bounce back, not exactly sure when. Well, as the new fiscal year started and this quarterly book attests to, we're starting to get that snapback. And so we're seeing pretty much a complete reversal of what we were experiencing the prior 9 or 12 months. So with that, I'm going to start on page number 4 of the quarterly book. And as you may recall from this time last year, at the beginning of the year, we always include a letter from our CEO, Mike Welker. And I'm not going to sit here and read the letter to you, but I do want to just highlight a couple of things that are contained. First and foremost is a thank you. Certainly, we appreciate the opportunity to serve you and the participants. As a reminder, the firm is committed to reinvest 100% of the profits back into the business. The last number of years, that's really manifested itself in two ways, technology and personnel. The short version is that's going to continue for at least 2023 and probably beyond. We do detail some of the past investments, personnel, technology, and so on, but really it's just a statement that that's going to really continue to be the area of focus. Then the other side of this letter is an update to the partnership. So as a reminder, ANCO is a 100% employee-owned partnership, but we are in a program where that ownership is being distributed among a greater number of the employees. So on the very top of the right-hand side, we had 3 new partners added, John Breath, Tyler Grumbles, and Brooke Wilson. So certainly very excited to see them added to the partnership. The one thing that's sort of new or unique this year is we actually did lose a partner. So we detail that in the middle. Donna Sullivan, who was our longest tenured employee, she did make the decision to retire at the end of the year because you have to be employed to be a partner. As she retired, she had to recycle that ownership back. So we lose her as a partner. Certainly excited for her personally, but we did lose her as a partner. So we had a net change or an increase of 2 folks to the partnership, adding 3, losing 1. And again, it constitutes a change in ownership, so we want to make sure we're disclosing that to you. But again, this is just part of the long-term plan. On the next page, we've got 93 folks at the firm. You've met or seen a couple of the people from time to time, but just want to make sure that we remind you that obviously it's a very deep bench behind us, whether it's the research group on the right-hand side, performance reporting, consulting, obviously the different functional areas of the firm. Just want to make sure you have that information because, again, sometimes you kind of forget that there's a lot of people working in the background. So just wanted to, again, make you aware of that. With that, I'm really just going to touch on the total fund number and universe percentile for the first quarter. So I'm now on page number 20. And again, kind of going back to my comments earlier, we saw a wonderful snapback. Part of the pain, if you will, in last fiscal year was our enhanced or equity exposure. So certainly that hurt on the downside. But now you're seeing a huge bounce back in recovery. So just in the 3 months, we're up 11.8% versus our policy of 7.9%. So equities rebounded, they did well, would have been up at 8%, but we did even better. A big part of that is the allocation. We have more equity than our policy because we've underweighted real estate and fixed income. So we have a little bit more. And then on top of that, your managers themselves did better on average than their respective benchmarks. And you place, again, in the number 1 percentile for that, either the quarter or which of course is the same as the fiscal year. And then again, we've got the long-term rankings. Obviously, the last 3 and 5 years has been a little hiccup, in part because of the last 12 months. Certainly impacted that number. But again, when you get out to those longer periods, certainly fantastic performance. And then the only other thing I wanted to mention on page 21, just because DGI and Fred mentioned it, they've been your manager for 42 years. What you'll notice on the far right-hand side is we show an inception of October 1994 for them, which is not 42 years. Again, the data that we were able to pick up didn't go back that far, so I just wanted to highlight that there can be differences.
That explains the difference between his 14.1 on inception to date and your 11.68.
Because I
even wrote that down, but why?
I don't go back
You don't go back that far.
Well, and
Okay.
to be honest, DGI didn't even exist in '94. DGI came into existence in '97 or so. Prior to that, Fred managed money through a company called Mitchell Hutchins, which the plan owned since the '80s.
Okay. But that explains the difference in those numbers.
Correct.
Okay.
That really, in a nutshell, is all that I wanted to highlight here. I'm happy to go through as much detail as you'd like me to, but otherwise, why don't we jump into the January flash, because again, that's even more up to date.
Okay, jumping into flash.
So page number 2 just kind of briefly looks at the asset allocation. And again, the trend has been in place. We're underweight fixed, underweight real estate, and then overweight equity. So in the last 4 months, that's really been the perfect place to be. As you flip over to page 4, you can see the actual returns. So just for the month of January, up an additional 7.9%, outpacing the benchmark of 6.1. And then when you add that to the 11.8% from the fourth quarter, and that FYTD, fiscal year to date, the 4-month number, 20.5, and again, that's net, versus 14.5. So not only fantastic, I mean, if it was just the market, we'd be off to a great start at 14.5%. But through allocation as well as manager outperformance, you've been able to add significant value to the portfolio on top of what the market has done. As we jump into page 5, just kind of touch on some of the individual managers really quickly. Really in domestic equity, everyone did well this month with the exception of DGI, and I say that loosely. They were still up 8.1% in 1 month, but their benchmark was up slightly more at 8.7. But otherwise, each of your domestic managers outperformed. And I would like to point out Brown. That is one that we've kind of been talking about extensively over the last 12 months or so. They did outperform slightly for the month. And if you look on the fiscal year-to-date basis, so the last 4 months, 15.7 versus 10.7. So we've really seen a kind of a nice little turnaround. Obviously, it's a relatively short time. But one thing, typically when you have a growth manager, I would ask the question about interest rates and valuation, but they're so focused on their portfolio, they tend not to think as much about the macro environment. So I ended up not asking. But what I wanted to sort of mention or tease out to you is companies, generally speaking, that had high growth rates got hammered the most last year. They started to see it turn a little bit in the fourth quarter, a little bit, but it really happened in January, where ultimately the Fed, when they increased their quarter point on February 1st, that day, the companies with the highest growth rates were up 3% and 4%, while the rest of the market were flat. And you started to see that little bit of an inflection or a shift. Now, maybe the Fed print yesterday and some other things, maybe we'll mute that just a little bit, but kind of generally over the past few months, we've started to see kind of a re-rotation or a flip back. Growth had done really well in 21, value did nothing. In 22, it was all value, and growth got hammered. And now we're starting to see that. And then even more so within growth, those higher growth names doing better, certainly, than they had done last year. So again, very nice to see Brown kind of recover there. Pazina, fantastic return, up 12%. I mentioned DGI. The other one is Bailey Gifford, so it's kind of a similar theme. On the growth side, growth names that got absolutely hammered in 22, really starting to see them bounce back. They were up 14% versus their benchmark of 8. And now for the 4 months, 29 versus 24. So again, very nice kind of recovery there. Loomis and Fixed actually getting a positive return. We started to see interest rates fall just a little bit here. And then the last piece is Principal, your real estate fund. Again, relatively small amount. But if you recall when we were meeting last time, the expectations, we were starting to see the prints come in that real estate was rolling over. And in part, it's sort of opposite happening what's happening in the public markets. But last quarter, the Odyssey benchmark was down 5%. We're in a period where they're essentially saying it's going to be down another 5 or 6% in the current quarter, and then we'll see what happens next quarter. But there's certainly a repricing there. The good news is it's a relatively small allocation. We are in the queue to get some of that additional funds back, which is every fund in the benchmark has slowed that down. Everyone now has a queue in place because there have been a lot of redemptions, and obviously you can't sell those properties quickly and easily. So they're slowing that down. Most of them are paying out roughly 10 to 15% on a quarterly basis. That's kind of the average right now. Now, obviously, that could accelerate dramatically in another quarter if activity begins to pick up. But that's generally how the pace they've been operating under. All that to say, I think as we're seeing these interest rate increases, cap rates rising, additional pressure, not to say that we're looking for some sort of cataclysmic event in real estate, but the discussion that we started last time about potentially maybe some value add or opportunistic real estate, that the expectation of future opportunity is still there, and if anything, it's growing as opposed to subsiding. So again, not that it's urgent, has to be done now, but just to the extent that there's continued interest, over the next 2, 3, 4 months, or even quarters, continuing to look at that or continuing to think about it, likely there's some continued opportunity.
What about, I think we're still under allocated to our bond allocation, which we knew.
Correct.
Given the change in the environment, I mean, at what point you can start, clipping, I think, 6-month T-bill as an example, so it was, or 1 year was 5.07 the other day. I mean, so at what point do we say, hey, let's start refilling that bucket? We're actually getting paid less than inflation, but it's not as bad a drag on our assumption rates, and so.
I think we're getting there. William and I actually talked about it a little earlier, that in particular, and again, you think back where we were in fiscal year 22, as we're coming up to the end of the year and needing cash.
Yeah.
We said our equities are down 18, 20, 25. We don't want to be a forced seller. Let's use the fixed income.
Right.
And if and when we get the rebound in equity, we'll look to backfill or use that as a source of cash. And here we are 4 months later, up 25%, in some of your equities. And so I think we're very much there.
Okay, good. I think that makes sense, because, yeah, okay.
Well, would Loomis have you'd have to enter to sell?
I'm sorry?
Would Loomis, let's say you want to get rid of Loomis and just go with CDs or something, it's paying more than they're returning at less cost.
No, I don't think there would be an issue liquidating out of the Loomis portfolio. It's an interesting question, going shorter term. That is one option. You're starting to see some funds do that, or not necessarily eliminate their longer term bond positions, but instead of adding to it, add shorter term at the higher yielding part of the curve. So there's certainly
We're always waiting on that next quarter point.
The issue with the shorter term, though, is the reinvestment risk in 3 to 6 or 9 months, so you've got to, it's an art, figuring out what maturities you want to buy, right? But, and we're going to be looking at doing a rebalancing and withdrawing some cash from the investment accounts at the end of March.
We're doing a quarterly account.
Right. So, we'll see. I don't think we'll get any money out of principal in that time frame. We might get 10% or so of what we requested. I believe I put in a request for $12 million to be withdrawn. I've got to go back and look at it. But, if we end up getting more from principal than we need for cash flow, then we would probably look at putting that into fixed income. And as we're withdrawing cash, we're probably going to withdraw some cash from equities, and maybe we'll do some rebalancing as well. We'll see what the markets look like. A lot can change between now and the end of March.
Just mechanically, do you do that on your own, or do you come back to this group, or how do you do that?
We have discussions with Brendan about it, but yeah, the timing of the PRC meetings doesn't really facilitate it. We'll have another meeting, but I have to put in letters of direction to State Street, several weeks in advance. So I'll put in the letters of direction probably the first or second week of March, and so that'll be before the next meeting. But generally speaking, we're going to rebalance toward target, not completely to target, but toward target.
But you can do that yourself.
Yeah.
Does it help you then to come back to us and have us support what you've done?
We talk about it ahead of time, like we're talking about it right now, that, maybe we want to start looking at shifting assets back into fixed income. So I take that into consideration. If the committee wants to, make a recommendation, the thing is, between the time the committee makes a recommendation and...
I was trying to do something to protect you.
Yeah. I don't think it's necessary, yeah.
The other thing I would add is, generally speaking, when this is happening, it's using the IPS as the framework, taking the current allocation and moving toward target. So unless it was a deviation from that, if it was a deviation from that idea, that's probably where.
No, I wasn't objecting, I was just asking how it's done.
No, but it's a very valid question.
Am I hearing you say, Brendan, that there seems to be a lot of money coming out of the private real estate equity?
There is essentially all of the kind of the core funds have an exit queue because people are redeeming assets. From what I have seen, it is not a position of, we think real estate is bad, therefore we want to exit. It's a denominator effect where as of September 30th, if you look back the last 12 months, equities were down 23, fixed income was down 12, and real estate was up 25. And so if you were targeting, say, 10%, you found yourself at 16. And so people said, okay, we need to redeem to rebalance the portfolio. And plans across the country are all doing it at the same time because, again, they're all in the same position. And so, a fund that didn't have a queue all of a sudden has $500 million of requests. And so,
But the up on real estate would be a measure of the private real estate equity, not REITs.
correct.
And, just for informational purposes, speaking to principal, they had put their queue in place back in June of last year. So unless you decided in the second quarter of the year that you were going to move money, you were locked into the queue. Yeah.
You started to see a couple had a queue in March, sort of the next, say, 25% did it in June, and then kind of the remainder had done it by the end of September, just depending on the individual fund and their sort of client base. But by the end of September, essentially everyone had the queue in place.
And I think the idea of looking at a closed-end or even an open-ended type of real estate value add or something like that is that, if you see the market correct down a bit in real estate, then if you bought in 3 to 6 to 9 months, you'd be buying in at low valuations. So it would make sense to buy in at that time.
That recent trustees class, I kind of agree with you, son, is that the REITs and private equity will balance out over time. At any given time, there's a significant...
They're always different from each other.
Significant variation,
Yep.
but they always, over the longer term, correct that way. So you wonder how much of that variation is in the appraisals, the private appraisals on private equity. How much confidence can you have at any given time that those things are accurate?
I mean, there's arguments on both sides. But to your point, again, we expect performance to be essentially the same over the full cycle. But what you have, and 22 is a perfect example. So at the beginning of 22, your core properties, you were fully leased. The economy, although inflation was an issue, you're rising rents, but you're getting full income, you're fully leased, and everything is going great. REITs, with the equity market, completely start to roll over in early 22. But if you looked at the actual real estate portfolio, it's like, this doesn't make any sense. It's fully leased,
Right.
fully occupied, everyone's paying the rent.
Right.
Why do we need to lose 20%, right?
Because of the market, the volatility.
The valuations are tracking more what's actually happening at that point. The REITs, what I would almost say, the REITs are trying to predict or price what's going to happen 12 or 18 months from now. Just like the equity market, we always say, is trying to discount next year. It's not trying to discount today. And so the REITs are anticipating what's going to happen the year following, and then they react up or down. And then what happens is, if they're correct about their, if they drop 20%, then what happens is the economy slows down, rents slow down, vacancies go up, and then the valuations that are beginning to reflect that information eventually write down the portfolios to about 20%. And so that's how they tend to perform over time. The return numbers are the same, but the timing is different. The valuation of the private real estate will lag what happens in the public market, because again, the public market can just hit a button, sell it or buy it, and start to reflect that very quickly.
Another thing that they discussed a lot was the possibility of recession. General concession that came out, it could be the second or fourth quarter, but don't be surprised if it's the third.
Okay?
That's like, I was having my daughter, the OBGYN wrote down the opposite of what he told her. So, oh no, here, it's right here in the chart. I said, boy, no. I said, girl.
Well, the one thing, obviously, there's a lot of debate. DGI kind of chimed in on it, and you ask 10 other investment managers or firms, and
You get 11 answers.
you're going to get,
Yeah.
exactly. For a plan like this, does it really matter? I mean, if we think we're going to go into recession in the third quarter, the fourth quarter, are we going to recommend a different strategy?
Right.
Are we going to say, because we think we're going to be in a recession, we need to then terminate or eliminate a DGI and add,
Right.
no, we want to partner with long-term strategies, maintain the asset allocation, rebalance as necessary, and work our way through that. So, I mean, I hate to be dismissive of it, but in a way, who cares? Whether we have it,
That's pretty dismissive.
But it's just interesting to watch where the consumers are going, how that's changed.
The more interesting question is how hard will it be, how soft will it be? And it appears to be soft, and
These charts indicate
therefore you're
that-
back to your, who cares?
Right.
Yeah.
I mean,
These charts kind of indicate the harder the recession, the better the recovery, so.
very true. But, from what we're seeing just in the data, it's really hard to have a really hard landing, so to speak, with employment the way it is.
Yeah, it's got to be soft.
If people, if the population in the country are earning their paychecks and they're still making money, you don't have this 20, 30%, huge drawdown. So it looks, if we have a recession, it would look
It's
to
going to
be
be more like
soft
that
landing.
bar there
Right.
than it is going to be like that bar there.
The rocket recession.
And they're spending more money.
And they're spending. But here's the thing, if that changes, if all of a sudden we start to see, the employment picture change dramatically and you start to get those sort of what I call historic recession level employment impacts, well, then all of a sudden, okay, this is not a smooth soft landing, this one's gonna hurt a little bit more.
I don't think that's going to happen.
I tend to agree because we're not seeing it. There's too much of a gap in the labor market that you still have that positive news. So again, but we're not out there trying to predict exactly hard, soft, when it's going to happen. That's not what we do.
Well, to the real estate, I think, they're Class A prime locations. Everything I've talked to is, the Class A, they're going to get, they may suffer short term. It's the Class B, Class C real estate that is going to be in the wilderness for a long time. And if it's overly indebted, or you got weak hands holding it, that could be ugly.
And I think that's precisely the point, especially weak hands. You had somebody come in at the top of a market, buying on variable rate loans that are 3% or something like that. Well, here they are 9-10 months later, they're paying 7%, and that's at a good rate, right? If they're a little more speculative, they're paying a higher rate. They're really starting to get squeezed. And if you live in that environment for another, 12 months, 15 months, whatever, you're going to have some forced sellers. And that's where the opportunity then presents itself, not so much for the core investor,
Right.
because again, you've got some issues, but these more opportunistic or value add strategies that say, hey, I can go to Tulsa, Oklahoma or something, a second tier market or what have you, and buy something on 50 cents on the dollar.
Right.
And that's where you get that sort of value creation, as opposed to, buying an income rental stream. Because that's what, core, at the end of the day, you're getting inflation plus a rental stream, or an income stream. And that you're not going to get that sort of opportunity in that sort of situation.
Very good. Well, any other, anything else?
No, that's everything that I'm happy to address any other questions, but that's everything.
Wayne, Greg, anything from your end, administratively, you want to bring to the board, or we covered everything?
I think we're good.
Okay.
We'd be good.
Having said that, I'd entertain a motion to
So moved.
terminate. Meeting is officially ended. Thank you, everybody.